We continue our discussion with Infosys, and we've done with the P&L drivers largely. We're now going to focus our attention on the balance sheet drivers. Now, on the balance sheet, primarily there are some headers which are going to come, which are going to get projected, which is your working capital projections, current assets and current liabilities. And we've seen that working capital is typically seen in terms of a percentage of sales, or number of days worth of sales is what we are trying to kind of focus that on. Usually, if a company has 100 crore of sales and 20 crore of receivables, you would expect that with 200 crore of sales, the receivables would probably move to 40 crores, right? So we would want to identify if there is a broader trend in terms of the revenue and working capital being related with each other, or the current assets, current liabilities, and revenue being related to each other. And we will try and start with that set of discussion now, which is then going to be called as the working capital drivers, right? And we're going to look at the current assets first, which are the current assets that the company has. So when you look at the current assets, the company has zero inventories, current investments, inventories, receivables, cash balances, loans and advances, other current assets, right? Now, uh, out of these, current investments are basically cash equivalents, right? These are cash equivalents. So cash balances and cash equivalents, we're not worried about. We're worried about receivables, and we're worried about loans and advances. Even other current assets for that matter has been zero for the last few years. So we are only worried about receivables and loans and advances. So that's the two headers we're going to put here. We're going to put in receivables and loans and advances. And I'm going to pull those numbers from there, INR crore, INR crore. So let's actually just link those numbers to the balance sheet data. That's my receivables number. That's my loans and advances number. We drag it on the right side and we format it, correct? So that's the data we get for these current assets. Now we're going to look at the data for current liabilities, and current liabilities, we've just clubbed everything together. Current liabilities and provisions. And this is also in crores, and I can just directly link it to the balance sheet, current liabilities and provisions number. There's only one line item there, so we can just link it straight away and drag it to the right side, right? And that's my current liabilities and provisions number. We have left out cash. Why have we left out cash? Because finally cash will be the balancing figure in this model. When we build the cash flow, the ending cash is what will go and sit in the balance sheet. We don't need to create any drivers for that. The driver for the cash would be the cash flow itself, right? Everything else in the balance sheet needs to get projected, but cash is what will come and fit in from the cash flow statement. So we don't project cash, right? Now, if I were to convert these numbers, current assets and current liabilities, as percentage of sales, right? So we can do this, and we can take each of these headers and just divide it by the revenue number, right? So where's the revenue number? That's here, and you freeze the row, not the column. So you find about 17% of sales is outstanding as receivables, and this number has hovered around 17 to 18%. I can drag it down. I can remove these zeros because there's no data there. So my receivables are almost constant at about 18% of sales approximately. My loans and advances earlier used to be higher, but in the last 4 years they have centered around 11.5 to 12%. Current liabilities and provisions definitely see a jump in the last 2 or 3 years, right? Which used to be 20% earlier. That's now become somewhere close to 24, 27%. So there is a jump in current liabilities that we see. We can figure that out, right? We can also, so I will write as percentage of sales here. We can also convert this in terms of the days notation, right? So in terms of days sales outstanding, right? If something is 20% of sales, then it must be worth 73 days worth of sales. If something is 20% of sales, so let's say my sales is 1000 crore and my receivables is 200 crore, that's 20% of sales. How much do I do the sale in 365 days? So that's about 2.75 crore a day, 2.7 crore a day. That's per day sales. What I have calculated is per day sales. So if I were to convert receivables in terms of number of days, this divided by every day sales, 73 days. Now you will note 73 is 20% of 365, right? So 20% of 365. And what was 20%? 20% was the receivables as a percentage of sales in our example. So all we need to do is if we convert this number to days sales outstanding, right? And I say days sales outstanding. This is a concept that we would have probably studied in financial statement analysis. And all I need to do is I can calculate this mathematically in terms of the formula that is typically taught to us is 365 divided by the, let's say, receivable turnover ratio, right? Now, what is receivable turnover ratio? That's sales by receivables. What have we done here? We have done the reciprocal of this. We have done receivable by sales. That's what we have done here. So all we need to do is rather than take this division, we have to multiply this with 365 and we should get our answer. Correct? We have to multiply this with 365 because we have taken the reciprocal and we should get our answer. So what do? I go here, multiply 17.4% with 365 and drag it down, drag it on the right side, and let's format it. So what do we get? Roughly 2 months worth of sales is outstanding as receivables, 66 days, 65 days, etc. Roughly 1.5 months worth of sales is outstanding as loans and advances, and usually Infosys is paying the liabilities, current liabilities, after about 100 days, right? That's basically what the calculation says. That's what we have to project for next year. We see a broad trend that exists in the first two headers very clearly, around 2 months of receivables, around 1.5 months of loans and advances, 1.5 months of sales. And here we have to figure out what happens. But if we assume an average of the last 3 years where they jumped, that's about 100. So about 100 days of sales is current liabilities and provisions. Once we project these for the next year, once we assume these for the next year, we would have our current assets and current liabilities numbers fixed, right? Let's go to the balance sheet again. We also have broadly some headers which are defined. We will assume that the company does not take or repay any kind of loan, so we'll keep the loans amount constant, or we can keep it at 0. It's anyway negligible compared to the balance sheet size of the company, right? Already done the projection for current liabilities. Share capital would probably remain the same, but reserves and surplus is going to come from your profitability. So whatever is next year profit, the liabilities side of the balance sheet will get fixed from there. Current assets side, other than cash, everything else we have projected. Current investments is treated as cash equivalent, so we don't really project anything there. Some of the items it will be difficult for us to project. So for example, it's difficult for us to project this set of data. So we are going to take a broader assumption at this stage, which is that this data is going to remain constant or similar. We now turn our focus to the attention towards the CapEx schedule, which is what kind of tangible, intangible assets the company has, and what is the capital work in progress for the company, and how do I project this number? Now, broadly speaking, all assets that the company has, should correspond to broadly the capacity of the company. And what is the capacity? These assets should correspond to capacity of the company. And what is the capacity of the company? It's the number of employees that work in the company, right? So based on the number of employees who work in the company, I'm going to find these values. Remember, however, these are net values, current value of the assets. We will also need gross values, right? So I want gross long-term asset values, and then I can remove the accumulated depreciation, and then I can find the net long-term asset values. Where are these data points going to be available? They're going to be available in the balance sheet of the company. So let's look at the balance sheet of the company for 2016. When I look at the 2016 balance sheet, annual report, consolidated balance sheet, page number 142, you will look at fixed assets, tangible, intangible. You see a note number 2.7. So note number 2.7 is going to give me details of what is going to be my gross value of these assets, right? So let's go to note number 2.7. That's the 2.7 note, right? What we see here is the gross value of tangible and intangible assets, and then you see the net value, which gives us the final final book value that that we get of the total number of assets, right? Let's try and look at the numbers and try and understand what are the numbers that exist here. So when we look at this, we find the net book value of assets at 13,180, right? This should be the sum of tangible and intangible because we are adding both of these. So 8637 and 4543, these are the numbers which were there in the balance sheet, 8637 and 4543. When you add these two, the sum is 13,180, which is what we see in the annual report, correct? What is the accumulated depreciation? That's this number, 7490, and the gross value that we see, the gross value is available here, 2670 is the gross value, right? That's what we see as the gross value. So we're going to put in the gross assets, we're going to put all this together, right? So gross long-term assets, tangible and intangible. If you want, we can put them separately. So let's put tangible first and then put intangible first and then put the total of these two here. So for 2016, my tangible number is effectively 16090. Where do I find this number? This is the tangible asset, 16090, and 4580 is the data for intangible assets. So 16090, 4580. Let's put these as 16090, 4580. That's the sum of these two numbers, correct? That's the sum of these two numbers, and we can then put in a header for accumulated depreciation slash amortization, and we can get the net fixed assets number. So what is the accumulated depreciation and amortization? That number can be found here, 7490. We plug in 7490, and the net value is 20 minus this, which is 13,180. That's tangible plus intangible put together, remember. So this 13,180 corresponds to the sum of these two headers, which is 13,180. It should match, right? Now we look at data for the previous year. So this is for 2016 that we get the data as. 2015 data. 2015 data is available for the previous year here. So that's as on March 2015, 14,108 and 3708. 14,108, 3708, right? So I can plug in this data as here, 14,108, 3708. That's a copy paste. I can drag this formula as well. I can drag this formula as well, right? And we can actually get hopefully the data for 2012 as well should be available, right? And the accumulated depreciation and amortization number is 6470 for last year. That's the 6470 number. Let's plug in that number here, 6470. What we get is 11346. Just to double check, the sum of these two should be 11346. The sum of these two should be 11346. 6, right? That's what we get. So that's the data for this year. Now, if I want to look further, there is data available for 2014 as well, right? So you look at the beginning as at April 1, 2014, that's 11580 and 2370. So I have that number as well. 11580, 2370 is also available. I can plug in the numbers here. 11580 and 2370. Is that the number? 11580, 2370, 13950. And the accumulated depreciation again for the year is available here. This number. So that's 5572. Correct? So let's look at 5572 and plug this number in and see if 8378 matches. So let's see if this 8378 matches. That's the sum of these two numbers, and that's 8378 as we see, right? So that's done for the last 3 years. We can go back a couple of years further in the previous annual reports. So if I go to the 2014 annual report, consolidated statements, we should see the data here. So that's my tangible intangible assets. Again, 2.7 is what I'm looking at. So let's move ahead to 2.7. That's my fixed assets number. And the data is available for this year and the previous year. So let's look at the data that is available here. That's 11580. And that's the total of tangible assets. The data for 2013 is available here. That's 9017. That's the tangible assets. Intangible assets are 2364, 2364, 9017. So let's plug in these numbers, 9017 and 2364. That gives me the total 11381. What is the accumulated depreciation for the year? Depreciation and amortization as in April 2013, 4242 is the total number that we are looking at. So 4242 is the total number. 7139, let's see if this matches. 7139 is the sum of these two numbers. So we have plugged in the capex data for the last 4 years. That's 2014 annual report. I don't think we have data for 2012 in this. We can go 1 year back and try and find that data as well, but that's not too necessary for us at this stage. So we can ignore this data here, right? That's the gross total assets number, and that's the net fixed assets number, right? Now what I need to find out is why is the capex happening? The capex is happening because of the number of employees. Every time you take in an employee, there is going to be a capacity expansion ballpark, right? That's what we are trying to figure out. So we should have a scenario of gross long-term assets per employee. And remember, balance sheet numbers are year-end numbers. So employee numbers that we have to take are also to be taken as year-end numbers. That's not going to be average number. That is going to be year-end number, right? So what do? I find the number of employees and I write year end here so that we're all clear on what we're doing. Let's drag this a little bit so that the data is available. Year end number of employees, is that available? That's available on our assumption sheet. So the first row in our assumption sheet is the year end number of employees, and that data is available to us for the last 4 years or so. Can I find gross long-term assets per employee? That's 20,670 crore converted to rupees divided by the number of employees, and that's the data point. For every employee, approximately 10 lakhs is what the company is doing in the recent past. That's the number of, that's sort of the expansion needed in terms of the cost per employee in terms of what is coming in, right? So if we know that next year 20,000 employees are going to come in, and we assume that 10 lakh is going to be the cost, so 10 lakh into 20,000 is going to be my capex for next year, which basically brings us to the understanding for capital expenditure product, the projections for that on account of new employees, right? That's in INR crore. I can calculate that number. So how do I find the new employees? Let's say the next year number of employees is 2 lakh. So the new employees would be 2 lakh minus the existing employees multiplied by whatever my capex per employee I assume, right? So if I assume this number to be 10 lakhs, I put that here. But this, remember, is in rupees and I have to convert it to crore. So I divide by 10 raised to 7. So about 595 crore of capex would be needed if they add another 5,000 employees, 6,000 odd employees next year, correct? These, remember, are assumptions. These are assumptions that have to be plugged in. Right now, we don't have that data. I'm going to remove this data, but the formula has been plugged in, so that formula has been calculated. We will redo this when we arrive at the projections. Now, even if the company does not add any capex, there is going to be a capex on account of maintenance, right? You do have wear and tear every year that has to be replaced. Now, where do you get wear and tear data, right? So to get wear and tear data, we basically find out that there's a number called depreciation, right? This depreciation in a way is telling us what is the wear and tear for that year. So whatever the company does, if it does not add any more employees, it will still have to add assets worth whatever has been depreciated last year, right? Otherwise, a scenario will happen where every year the assets will keep getting depreciated. If we don't keep on adding the assets, then at some point we'll end up with zero assets. So there is going to be some capex that is going to be on account of maintenance, and that is nothing, but I can just make a simple assumption of the depreciation for last year being my capex for that next year, right? So I'll just plug in the depreciation numbers from the P&L, and all I need to do is say that this is nothing but depreciation for the last year. So that's my depreciation for the last year. Let's also insert a couple of rows here so that we get total capital expenditure, right? And that's nothing but the sum of these two. So all I'm going to do is calculate the depreciation, and that works there. And just while we are at it, depreciation should be as a, or let's put this here, as percentage of gross long-term assets. Let's see what that number works out to. So I take this and divide it by the gross long-term assets, and I kind of continue this in the further years, and we find this number has now become about 5 to 6% over the last 2 years. Earlier couple of years this was higher. Maybe some change in depreciation policy, maybe some calculation changes that have happened. We're not sure, but it seems about 5-6% of the total gross long-term assets appears as depreciation every year. That's what we're going to project in the subsequent years as we go along, right? That's broadly in terms of our balance sheet drivers. We now have everything in place to be able to make a projection for the 2017 numbers. Once we make a projection for the 2017 numbers, we would have a completely linked model. That's when we get into the idea of trying to identify what should logical assumptions be, right? And then we kind of calculate the free cash flow to equity. We try and then value the company based on a DCF model, right? So that's it in this particular video.